Good morning. It's Wednesday, the 28th of August, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take: why Indian investors perhaps need to be reined in. Now, there are two ways to see it. One, the brute power of free market capitalism when a company operating 2 Yamaha motorcycle showrooms in Delhi employing 8 people raises 12 crores in an IPO, or rather raising 12 crores in an IPO or initial public offer, and is oversubscribed by 400 times, already attracting bids worth 4,800 crore rupees. Now, the IPO price for this company, Resource Automobile, pitched on the SME or Small and Medium Enterprises Exchange, is 117 rupees per share and is apparently already quoting at a grey market premium of 72%, according to Money Control. Or the other way, investors have lost their collective heads and are now indulging in what I would call casino-grade punting, like there's no tomorrow. And the answer, like it usually is in such cases, may be somewhere in between. Pranav Haldea, the managing director of Prime Database, tells me that last year the average listing pop was 77%, which means people who got shares in IPOs could sell at a 77% gain when it listed, which not only means that people are making or made some cool returns in a short period of time, but also that others were buying in at that point, hoping for even greater returns. And in many cases, all parties evidently ended up satisfied, at least going by the data for that period. Moreover, Pranav tells me in our conversation that's coming up shortly, in 2019, the SME exchange used to see an average 408 applications per IPO, while this year the average is running at 213,000 applications per IPO, including for, of course, our friendly motorcycle dealer. Overall, the IPO market is likely to see amongst the highest raises ever and definitely more than in recent years. And there's more to come. Some 44 companies could raise around 100,000 crore rupees if all filings get cleared and they actually decide to hit the market this year. And this could include mega IPOs like Hyundai Motors India arm. So there is a market and there is the ease of access to it. Investing in IPOs, like in many other segments of markets, is via a swipe on the mobile phone now. And many investors are, like everywhere else, first-timers and have got into the game only post-COVID. The lure of easy returns is only increased as anecdotal evidence piles up, with each or rather most IPOs doing well and then shooting up further. It takes a year or even more for investors to figure that the stock that they had bought with such glee was a fundamentally weak proposition to start with. Let me give you some quick examples. Paytm of 197 was offered at about 2,080 per share, listed around 1,950 per share. That's already a discount in November 2021 and has never seen that level again. It's now down about 65% since listing. Nykaa listed a few days before Paytm at about 2,000 rupees on the BSE at a premium of 78% of the issue price of rupees 1,125 and was down to about 406 in a few days and now quotes around 226 rupees. There are and will be several more such examples. I just took 2 of them because these are brands that you will surely recall and remember. Now, SMEs, which is the smaller IPOs, are regulated or run by stock exchanges, and the Securities and Exchange Board of India does not play a role there, unlike in the larger main board IPOs. And the exchanges and SEBI, for that matter, have been tightening norms gradually for these SME stocks. We should also, of course, not start believing that all the problems are only in these small exchanges. Remember, the examples I quoted to you were actually the bigger ones. The problem is also fundamental. There is little connect between the person who takes a punt with a swipe on the mobile phone and an equity market cult, which in some ways hopes to achieve a larger objective of mobilizing capital for productive use. To be fair, that's happening too, but at a level that's now in some ways entered a red zone. You spent the many years before and into COVID inviting savers to invest in mutual funds in specific and the markets in general. But with high inflations and incomes not meeting aspirations, savers, young and old, are crowding into stock markets in desperation, particularly in recent years, with the hope and aim that small bets are fine because the returns are high. We have now, in some ways, to create more barriers to quick app-based investing and educate investors to think more long-term and see the stock markets as a longer-term partner of sorts. For it is these small investors who will suffer when they get caught out, as many surely will. And then the blame game starts, as it did when Nykaa's share price, for example, fell. It's tough to preach free market dynamics to first-time investors who were in it for a sure short-term gain. And that, unfortunately, is the feature of every bull market everywhere since time immemorial. And that brings us to the top headlines and themes for the day. The stock markets are on a steady upward trot for 9 straight sessions now. Maruti says there is no inventory problem, unlike what the dealers say, but the problem is larger. Zee and Sony say all claims on each other are off following failed merger, what this means for the industry. And primary markets are overheated, what can be done?
This is a Core Report with Govindraj Ethiraj.
Another flat day at the markets. It was yet another flat day, which could set the tone for the current time since there are no major triggers either way on the horizon. Remember, there's a lot of money flowing in, but it's also going into primary markets, as we've discussed and will discuss later in the show. The BSE Sensex closed at 81,712, up 13 points, while the Nifty 50 was up 7 points, higher at 25,017. Despite the flat run, the Nifty 50 has now risen for 9 straight sessions and in sniffing distance of its record high. Energy and consumer stocks fell even as financials did well, as a global rally kicked off by potential interest rate cuts has already slowed down thanks to rising tensions in the Middle East, according to Reuters. Domestic institutional investors have been buyers for 16 straight sessions, buying Indian stocks worth about 48,000 crores or about $6 billion, according to Reuters, who also added that Asian stocks were weak, even as Brent Crude was holding steady after rising last week. Crude, however, is now clearly over $80 a barrel. The Zee Entertainment stock was up about 12% after it announced that it settled a merger dispute with Sony, and more on what that means and a quick look at the overall media sector shortly. Maruti says no inventory problem. India's largest car maker, Maruti Suzuki, said its dealers held about 38 days of inventory in anticipation of the festival season, which has started now. But this is expected to reduce to 10 days by the end of the year, its company chairman R.C. Bhargava told shareholders yesterday in a report quoted by Business Standard. Of course, this is not what the dealers are saying, who claim that they're holding over 60 days of inventory in general. The issue is not so much about whether it's 38 days or 60 days in itself, but the question as to whether demand is slowing down, which it evidently is, and therefore by how much. Or car makers have got their demand projections totally wrong. Or in the case of Maruti specifically, maybe the inventory level is not that bad as the chairman suggests, but I'm not too sure. The Maruti chairman also said he expected that demand for small cars, which had also slowed down, was likely to revive by March 2026. So this is where it gets interesting. Maruti has been betting strongly on small cars doing well as a segment, and that sounds fairly logical. And perhaps that is the area where the vehicle pile-up at dealers, at least in the case of Maruti, is higher. The Maruti chairman said that he firmly believed that low cost and small cars were necessary in that's India's economic and social conditions, and a temporary setback in demand would not change their strategy. But data has been suggesting that people are actually not buying too many entry-level cars, including in my conversation with the dealership associations, because of the larger move towards premium products and challenges, including getting loans at entry-level segments. Remember, to get a loan at an entry-level segment, you have to put down your contribution to it, which has been a challenge. That, by the way, is the situation in low-cost housing too, which has seen a dip in recent years. Of course, all of this could change, but do note that a pickup in the small car segment would suggest a much larger revival and shift in consumer behavior from what we've been seeing in the last 2 years or so. At this point, we don't know how this will pan out. All I would say is that the trend lines are much larger than just the car sales numbers that we are tracking or many track. Meanwhile, Maruti also said their first electric car will be launched in the next few months. It would be exported to Japan and Europe and then brought into the Indian market. Remember, Maruti, parents Suzuki, Toyota and others have been campaigning against full electric and pushing the hybrid cars instead, a strategy which of course has worked very well globally, including in India for these companies. The Zee-Sony split is done. What does it mean? Zee and Sony have reached an agreement to amicably resolve all their disputes following the calling off of a $10 billion merger between the two. The merger was actually called off around January this year after being in the works for almost 2 years. The result would have been a network of some 90 channels across entertainment and sports, taking on, amongst others, Disney and Reliance, who are of course now set to merge, and more on that shortly. Zee had then responded to the move by sending a notice to Sony asking for damages. Sony had said it pulled out because it reportedly had more than 20 compliance issues with Zee, according to a Reuters report. Zee's founders and promoters were also being investigated for diverting company funds by SEBI around the time the merger process was on. Zee stock was up more than 10% yesterday, so the markets obviously received the news well, though it would appear that both companies still need to find their for a new or renewed beginning. Because the reasons they were exploring merging, among other things, was obviously that a market or the market was screaming for consolidation in media. So I reached out to Karan Taurani, Senior Vice President of Elara Capital and media analyst, and I began by asking him where Zee and Sony stand now and what does this say about the overall state of consolidation in media in the country and, of course, the near future.
So I think officially the merger was called off in the month of Jan. And I think, this is just an addition to that. This will provide a respite to see in terms of, their valuations. This will provide them some kind of a headroom to potentially, look out for another strategic partner if at all, they are in process of that. And in terms of Sony as well, things are setting quite clear. It will probably help them also to find another strategic partner in case they are. So it's the end to the Zee Sony story, and both these companies will now look at the future ahead with a new potential partner or looking at going to the market on their own right now.
I'm going to address the larger issue of consolidation, but in both these cases, the reason they were coming together to merge was because they were being driven by certain macro factors. So where do those stand today? And can either of these companies survive on their own, or as you said, they will have to go and seek fresh partners?
So, the major reason for doing the merger was, of course, the converging growth rates in the linear TV side, digital seeing heavy content investments and, hefty losses. So the logical reason for do this merger was to build synergies on revenues, to kind of go to market together, get better ad pricing, get better revenues on subscription side, to kind of get, cost savings, which could lead to synergies as well on both technology, content, and employee expenses, everything put together. So that was the entire rationale of, doing this merger so that they could grow at a faster pace, gain more market share, gain more clout in the market. Now, with the merger being called off, clearly, they can obviously survive individually as well, in terms of both these companies. But they may not be able to gain market share. They may not be able to see acceleration in terms of their growth rate. So I think those challenges and issues will persist. So in case, they want to accelerate and in case they want to kind of increase their momentum in terms of market share gain, they will need to tie up with a partner. Now, the next question is that who is the partner? I don't think there's any partner available now because of, RL, Disney already in talks. These two are the other two large players in the market today. So if this deal is not happening, eventually they don't have a partner. So they might look at, probably, getting some kind of a strategic partner, getting some kind of a funding or getting some kind of a acquisition of a smaller company put together. But this was supposed to be like a very big powerhouse company, which could kind of compete with the might of RL Disney. So both these companies working individually will not be able to compete in a same manner as they would have had the merger would have happened.
You touched upon Reliance Disney. So where does that stand now? So they had some feedback, we understand, from the competition commissioner saying that, they'll have to shed some businesses and come back with a fresh proposal. So where does that stand? And of course, the next question is, where does the whole sector stand at this point?
So I think in terms of RL Disney, the CCI approval process was bound to take time. I think, you have to, articulate the fact here is that both these companies have got a strong market share, viewership share across multiple genres. So if you look at the GEC genre, they would have a ad revenue market share of, more than 40% on the linear TV side. If you look at the OTT market, again, with both these platforms coming together, they will control about, 35% of the India's OTT market as well. So I think given the kind of size and scale, like if you look at sports genre for that matter, they would have a command of more than 85% of India's, sports ad revenue. So I think it's quite logical that these kind of obstructions will happen. But net, I think, there's a very high likelihood of this, merger going through. I think on the GEC side or the OTT side, they might have to, kind of shed some assets or some smaller channels wherein there's a very big overlap or the market share is more than 40%, 50% rather. And on the sports side, their market share is about 80-85%. Now, here, I don't see them kind of shedding away in terms of their content because sports is a very different kind of a proposition. You don't own the sports content on a permanent basis. The renewals happen for these kind of rights every 4 years, 5 years. So, this kind of market share cannot, persist forever for them. That's the first point. Second point is, of course, you probably, these platforms are making hefty losses. So, if at all they are kind of stopped from bidding in terms of sports rights, the rights value will not be correct or will not be fair, right? So I think there has to be some legal recourse to this, and I think the teams will be working very closely, to kind of sort this issue as well. But high probability, I think the merger will eventually go through.
Yeah, and it's interesting that you say the area where they have the maximum, let's say, market share is the one area that may not be touched. So anyway, let me pose the slightly even larger question then. So when you take a step back, how is the media and entertainment sector looking like? Is it in flux? Is it muddled? Is there chaos? Where is it right now? And obviously, all of this is in context of revenue that there is and the number of players that there are.
Yeah, so I think if you look at the media industry, if you look at it from two perspectives, one is on the traditional side and the other is on the digital side. The traditional side, it's a good business with, very good premium margins, maybe 25-30% EBITDA kind of margins. But the growth rates have converged, to about 3 to 5%, which is phenomenally low. So in terms of ROI, return on investment, you will hardly see any returns from here on going ahead or any uptick in terms of valuations. So that's been a major problem. On the digital side, again, the growth rates are premium 15%, 20%, even more than that in certain cases. But again, there is no margin. Most of all the OTT platforms rather in India are making losses because of FT content costs, high technology costs, everything put together. So, on a nutshell, I think, what you'll see is that, growth rates will be in the range of about 7 to 10% for the media industry, for the larger players which are there. And margins will constantly be under pressure or remain at stable levels. We may not see, kind of big margin improvement because of heavy content cost investment, which will always keep on coming. So typically, you will see margin improvement for large players like maybe RL Disney because of synergies, because of route to market together, because of lower distribution costs, lower content costs, lower technology cost. But otherwise, if standalone players like Zee and Sony are operating, there will constantly be margin pressures because of larger players like RL Disney competing hard with them, and they not able to, being able to scale up, beyond the point.
Got it. Thank you so much for joining me.
Thank you so much. Thanks.
The primary market is going haywire. So it's not just Indian investors, by the way. Even foreign investors, according to a Reuters report quoting Central Depository Services numbers, have bought about close to $1.5 billion of issuances in the primary market, even as they have sold about $3.5 billion of equities in the secondary market this year. The stock markets are, of course, booming, and the primary markets are also at levels which could be best termed stratospheric. I spoke to Pranav Haldea, Managing Director of Prime Database, the country's best-known data integrator on primary markets for over 3 decades. And I began by asking him how he was seeing the froth in the market, particularly at the lower end, and also where the overall market for issuances stood right now and was headed.
We'll start with the main board IPO segment. And, as we speak, in this financial year, we had 28 IPOs already. Close to 40,000 crores has been raised. And we are at the end of August right now. In comparison to previous years, of course, it's early to say, but indications are that I think we might be heading for the best ever year in terms of main board IPOs. Just for some context, last year you had 76 IPOs raising about 62,000 crores, and the year before that was 37 IPOs raising 52,000 crores. But of course, we need to remember that in 2022-23, we had the mega LIC IPO as well. If one were to exclude that, then, only around 30,000 crores were raised. The reason I say that we could be heading for a record year is because of the pipeline which is there. One interesting part which I would like to mention, of course, is something which I have never seen in 20 years in the primary market, which is actually IPOs getting launched during election months of April and May. We looked at the data going back to 2004 election cycle, and 2004, 9, 2014 and 19. You didn't have any IPO during April and May, given the volatility which is typically associated with elections. This year, of course, there was a lot of prediction for a certain result, which ultimately did not bear fruit. But you saw record IPO activity in the months of April and May. You had 7 IPOs raising close to 15,000 crores then itself. And then, of course, after that election event has gone by, and more recently, the budget event has also gone by, you've seen more and more issuances hitting the market. Even as far as the pipeline is concerned, there are 22 companies which are sitting with SEBI approval, looking to raise close to 20,000 crores. Of these is the mega issue of Bajaj Housing, which is going to be close to $1 billion. Apart from this, you have another 44 companies looking to raise close to 100,000 crores, which is a huge figure. Of course, all of this may not materialize. And this includes the mega issue of Hyundai Motor, which is expected to be launched later this year, which is likely to be in the range of around $3 billion. You also have the Swiggy IPO, which is quite anticipated. And then other few large IPOs like Vishal Megamart, Niva Bhupa, some of these companies which have been, waiting SEBI approval. The filings continue. So, just after the budget and in August, you saw 16 filings in July, 17 in August. And there are several other companies which are in the pipeline. So I think the pipeline looks extremely strong. So this is, of course, the supply part. And as far as the demand is concerned, as not just the primary market has shown, but even the secondary market has shown over the last couple of years. There seems to be no dearth of demand, whether it is individual investors, retail investors, or HNIs, or on the institutional side. And there, the dependence that the primary market or even the secondary market in India, which is had on foreign investors, has significantly reduced. And this has, been in line with the growth of the domestic asset management industry, the domestic mutual fund industry, who are, become big players in both primary and secondary market. And our issuers and issuers have the confidence that they can launch issues and the issues can go through just with the support of domestic investors.
Got it. Okay. So this is the main board space, and some of the froth and therefore concern seems to be clearly in the SME space, which of course is supposed to be a more liberal platform, but that liberalness means also that things get in which maybe are not fully ready or maybe a little tricky for investors. What's your sense there?
It's been a bit of a mixed bag, and you've seen a lot of regulatory action against some of the SME companies of late as well. Some additional regulatory guidelines have come out from the stock exchanges. Some warnings have been issued from SEBI. So, of course, it's not to say that all companies need to be painted with the same brush, but it's been a bit of a mixed bag. Investors, in my view, need to approach this segment extremely with a lot of caution. Of course, we know that a lot of investors, especially retail investors, are coming into IPOs, whether main board or SME, from a listing point of view. And, here's an interesting statistic for you that in 24-25, the average listing gain of an SME IPO has been 77%. This is, the crore calculated on the closing price on the day of listing. Now, that's a huge return. Now, the other interesting data point here, which I would also like to quote here, is the number of retail applications in the SME segment. And, in 2019-20 financial year, the average number of retail applications was just 408 in SME IPOs, just 408 per issue. This number in the current year, 24-25, is already at 2.13 lakh. This is an average. So what I'm trying to say is that on an average in an SME IPO, about 2.13 lakh investors are investing. Of course, why are they investing? Because they're getting attracted by the huge listing gains which they are seeing. To examine these companies, not coming from a listing gain point of view, but study the company, study its business, study the promoters, its governance, and only then invest in this particular sector.
We have a free market for issuances, given obviously with some factors constant in terms of meeting all the requirements of disclosure and so on. But the SME thing, of course, as in any bull cycle, throws up some interesting examples. The latest one being a small two-wheeler dealership in Delhi, which is on listing, and there seems to be very little fundamentals. I mean, it's a dealership at the end of the day. There's no real asset there. And maybe it's a good business too. So what could an investor look for? I mean, what's the one metric you would say, okay, look for this. If you don't find this, then move on. I mean, not that they'll listen to you, but,
Yeah. Well, so, of course, this particular company has been all over the news today, I think since last night. Look, my view is that I think the number which is being floated around is that it got 400 times subscribed. The point actually which I wanted to make was that, these SME issues, as you know, are very small issues. This particular issue also which is being spoken about is just a 12 crore issue. So, given the number which I gave earlier, which is 2.13 lakh, let's assume that even this issue got 2.13 lakh applications. That shows, a lot of retail interest coming in. And hence, even a 400 times subscription is not something really to be alarmed about because the issue size is very small. In fact, again, for 24-25, on an average, every single SME IPO, the average oversubscription has been 200 times in this year. So 400, yes, of course, it's double, but it's not something which is, out of the park completely.
You said the average oversubscription has been?
200 times for over 105 SME issues that you've already had in this financial year.
Right. You're saying that there is nothing that can be done to, let's say, either make investors aware or to maybe check the IPO before it gets, put out into the market by the regulator? Or let me put it differently. Is there need for greater regulatory intervention particularly when it comes to the more frothy kind of IPOs?
Well, yes. And I think both the regulator and the exchanges are looking at this space closely. Of course, there's a different process for SME IPOs versus the main board IPOs. They don't require an approval, so to speak, from SEBI. The approval comes in from the exchanges, and exchanges are also, free to shape the guidelines. In fact, I think a couple of days back, you also saw something coming out from NSE, wherein they have prescribed further limit for SME IPOs hitting from 1st September, if I remember correctly. Of course, the other aspect is that these are small companies. There is relatively lesser information about these companies in the public domain. So the advice would be, in fact, similar to whether it's an SME IPO or a main board IPO, which is, you need to understand whether you're coming in from a long-term investment point of view or just from a listing gain point of view, right? Now, SEBI itself put up very interesting statistics at the beginning of the year, wherein they said that 3 out of 4 individual investors actually move out of the IPO within a month of listing, which actually shows that, most of the individual investors are primarily coming from a listing point of view. In that case, in a secondary market, you've historically seen that the chance of getting a listing gain is reasonably high. And I think what you're seeing is essentially that playing out, which is, retail investors are essentially investing in every single IPO which is coming out, hoping that they get some allotment. Obviously, with the kind of subscription that you're seeing, allotment is not a sure shot. In fact, the other, given the allocation methodology, at most in a lot of main board IPOs, you will get one lot, which is worth 15, 20,000 rupees. So actually, it is not significant in terms of moving the needle. But what you're seeing is essentially, individual investors, and this has been made even easier because of various apps which are available where in a matter of 2 or 3 clicks, you can invest in an IPO, unlike the earlier time where you had to get the form, fill it, give a check, so on and so forth. So it becomes so simple. So what you're seeing is, investors investing into every single IPO, hoping they get an allotment. If they get the allotment, lists at premium and then liquidating.
Yes, and it's interesting because when you say that it popped at 77% on an average or has been in the last year, it also means that people are buying at that point, hoping for a further appreciation for that same IPO.
Yes, absolutely. And I think that's where, the regulators and exchanges need to look more closely in terms of who are the investors at the time of IPO and who are the subsequent investors. They, of course, have all this data. Is it that the price is being driven up by a limited number of, people, and then, the shares are being offloaded to unknowing public? The other, important point to be kept in mind here is also that a lot of investors in India have actually come to the capital market only in the last 3-4 years, as the numbers have shown, and hence they are not aware of the kind of shenanigans which have played out in the market over the years. They would be even more gullible, so to speak.
Right, Pranav. Thank you so much for joining me.
Pleasure. Thank you.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.